Welcome to XREX Tea Talk. I'm Fred, and today I have with me Michael, who is the Director of Risk Management at XREX, and we're just going to share some views that we have, because recently Michael wrote an article about what happened with crypto lending platforms, namely like Voyager Digital, and there were a lot of things going on previously with the funds and the bankruptcies. So we just want to grab Michael today to just break it down for us and go through some of the key points that he brought up in his article. The article will be in the link down below, so feel free to check that out after this video. So to start things off, Michael, can you tell us what are crypto lending platforms?
Sure. Crypto lending platforms are a subset or a type of centralized crypto service provider. So they're distinct from a traditional crypto exchange, which more or less holds customers' assets on their behalf. Crypto lending platforms are a little bit different. They actually take customers' crypto assets, and in order to generate a yield and provide a yield to the customer, the company is granted with rights to do many different types of things in order to generate yield. And one of the most common things is for these platforms to take customer crypto and lend it out to other counterparties. So hence the name crypto lending platforms.
Yeah, and I think one of the major issues with the whole fiasco is that a lot of these loans are not collateralized, right? And they're just lending it out to projects and to other crypto lending platforms who might even further lend it to someone else.
Yeah, there's a very wide range of practices. We're getting a little bit of a glimpse into how they operated now that a few of them have filed for bankruptcy and there's some disclosures. So the practices are wide-ranging. There's just basic things like collateralized lending, which is probably considered on the safer side. So they'll take assets in order to lend assets that's collateralized. But as in the case of Voyager, if you look through their bankruptcy filing, it is noted that they made a very large loan to Three Arrows Capital, uncollateralized. So that was the beginning of the end for Voyager, and that led to their downfall once Three Arrows Capital had also defaulted.
So how do these platforms actually promise the returns or promise such high APY? What are they actually doing?
It is not always the case that the platforms are able to generate an extremely high yield. Sometimes they're offering customers very high yield just to capture or attract capital. But on the platform side, they can lend crypto uncollateralized, unsecured. They can lend it collateralized, but the return will be smaller. They can deploy any type of yield strategy. If you look at the terms of service for Voyager, it basically says in the user agreement, under consent to rehypothecate, the customer grants Voyager the right to hold cryptocurrency in the customer's account, and to pledge, repledge, hypothecate, rehypothecate, sell, lend, stake, arrange for staking, or otherwise transfer or use any amount of such cryptocurrency.
So basically anything that they want to do with your crypto.
That is probably a much faster and simpler way to say the same thing.
Yeah, because I saw the term sell, right? So even if the customer doesn't agree to or doesn't want to have their crypto being sold, using this platform and agreeing to the terms of use without looking at it, you are actually basically just granting them the right to sell your crypto.
And if you dig through the internet and research more, there are other firms, not Voyager, which I won't name here. They put funds into risky protocols. They were exposed to hacks and they lost money that way. So the risk taking can be considerable.
Okay, so when we put our funds in such a platform, or when we are using a platform that puts our funds through that platform to another platform, what actually happens and how are these yields actually generated? So what happens to my crypto when I stake, for example?
Yeah, so if you stake your crypto with Voyager or Celsius or whichever other firm, they will go and deploy those funds into a variety of strategies. They can lend it, they can stake it into other protocols, they can do almost anything they want to generate yield. And you can see that in the case of certain firms, those risky strategies or risky staking activities into protocols, which were subsequently hacked, actually led to the loss of funds for that platform.
So this was actually a very painful lesson for a lot of people, as you've mentioned in your article. So I think the most important thing that we do right now as a crypto community, and also when other retail users come on board crypto in the years to come, what are some of the things that we can ensure that what are some of the things that we can do to ensure that our funds are not misused when we place it in a certain platform?
Because of the fact that crypto platforms are loosely regulated, or in some instances almost unregulated, we really don't have that benefit of the protection of oversight or risk management. So as users, what we should do is to really cut through the marketing speak and cut through the advertising talk and dig into what these platforms are actually doing. You have to read the fine print, read the terms of service, and understand what rights you have granted these platforms. The platforms will tell you we're licensed, we're regulated, but in reality, I mean, it's a very light touch regulation. And in the case of Voyager, they even go as far as to use FDIC insurance as sort of a benefit or perk of the platform, when in fact that they have misrepresented the FDIC insurance. The FDIC insurance does not cover Voyager default.
Yep, and as Michael stated in his article, the part on FDIC insurance is actually insured against the bank who, which in the event of a bank run, their funds are protected. But it doesn't mean that your funds with Voyager were safe. So I think that was one of the marketing things that they did, and yeah.
Exactly.
Right. So now we are in a bear market. Some people think that it's not the full bear yet, but nevertheless, things are very different from how it was in 2021. So going forward, what do you think will happen? Do you think that we will still see crypto platforms and crypto lending platforms offering high yield, trying to attract customers in ways that we have seen in 2021?
I think many platforms and companies will certainly try to lure customers with high APYs and high returns. But I really do think after what has happened in the recent months with all these failures, the trust of the consumer really has been lost. So I think it will be a tough going for companies trying to replicate or repeat the playbook or strategies that the centralized lending platforms have used. I think going forward in the future, for the next phase of growth and adoption, hopefully we will see regulation implemented. So we'll have a safe perimeter for consumers to operate within. They can choose at their own discretion which regulated firm to put their funds. They know that there will be oversight and examination of these firms. There will be a baseline observing their practices, their risk management, their ability to safe hold customer assets. I think these types of firms, these regulated firms, hopefully will emerge. But the concept of borrowing and lending assets is foundational to finance. So there will always be, whether it's centralized providers or even in DeFi, protocols that you can interact with to facilitate this borrowing and lending. So I think there's still a lot of potential and promise in terms of the innovation on the DeFi side. So we could continue to see growth and adoption in terms of borrowing and lending and other types of features yet to come on the DeFi space.
So, yep, that's all the time we have for today's XREX Tea Talk. Thanks for joining us, and thanks, Michael, for your sharing.
Thank you.
We'll see you in the next one. Bye-bye.